Private credit versus broadly syndicated loans. Private credit has grown rapidly. It's one of the biggest questions today, however, is why private debt often carries less systemic risk than bank lending or what we call broadly syndicated loans. The difference comes down to how each market is built, who is ultimately responsible for the loan. First, ownership and incentives. Private lenders hold their loans to maturity, which means they keep the risk, they care about long-term performance. However, by contrast, you look at banks, they often issue loans and then sell pieces of them to investors. This broad syndication model creates a moral hazard because banks earn their fees upfront and they may not stay aligned with the loan's long-term health. So second, covenant protections. Private loans typically include stronger covenants. These are rules that limit how much debt a borrower can take and how to protect the lenders. Broadly, syndicated loans, on the other hand, they come what we would call covenant-light structures. Fewer protections means more risk. They don't care. They get their money up front. They sell them. So we don't need the risk. Third, private equity sponsorship. Many private credit borrowers are backed by private equity firms that provide oversight and operational discipline. This adds accountability. Borrowers in the syndicated loan market are not always PE backed. And they can be then vulnerable or, maybe mismanaged or potential fraud. I've seen a few of those. Fourth, let's talk about workouts and restructuring. When a loan runs into trouble, private lenders often work directly with the private equity sponsor to preserve the value and restructure it sensibly. In the syndicated market, distressed debt investor may buy the loans at a discount and use that aggressive tactics that can destroy the value for the existing lenders. And fifth, the role of CLOs. About half of all broadly syndicated loans end up packaged inside a CLO. When one loan inside a CLO deteriorates, it can create selling pressure across the entire structure. That is what we call contagion risk. Private loans are not packaged in this way, which means that one bad loan stays isolated rather than spreading it through the system. The lesson is that private credit is built on closer relationships, stronger protections, and has more aligned incentives. So at Sebold Capital, we understand and help clients understand where these private markets can offer opportunities and where careful diligence is needed. To learn about our fiduciary approach, why don't you visit us at seboldcapital.com, or you can give us a call at 630-548-9700. After all, it's your time. Spend it well.